Good day, fellow investors. I've just shared with you the most important video I made in the last 6 years, so check that out. And we discussed investing, we discussed the market, the basis fundamentals of the economy, risk mitigation there, the biggest investing risk, and how to invest. Where the conclusion was that it is all about you. You are your biggest enemy when it comes to investing. And can you take a 50% hit? Do you have the dry powder to take the advantage if a crash comes? Can you tolerate any squeezes? Are you at risk of someone squeezing you out with a loan, with something? And whatever happens, life goes on normally. If you are in that position, then you are in the right position to invest. But we want to discuss here portfolio strategy for 2024, where you can see whether your portfolio is fragile, robust, or anti-fragile. When it comes to fragility, this is a fragile payout. I took these slides from Nassim Taleb, hope he will not mind. But the fragile payout means that things are normal, everything looks great, stocks go up 10%, and then boom, then something happens and your empire is lost. A robust payout is no matter what happens, you are flat, and an anti-fragile payout is a reverse blow up where when everything goes to the gallows, you make a lot of money. So as I said, check this video out and also stick around for this video for important strategic decisions when it comes to investing. And we are going to touch on the S&P 500 in this framework, of course, treasuries, options, and one stock that we discussed yesterday, Walgreens, to all conclude with the strategy for your portfolio to do well over time. Let me immediately start with the S&P 500. The price-earnings ratio is now 25, the historical average is 15, earnings are not 250 but 180. Everyone is looking at the projected forward earnings that will never be 250. The dividend yield is 1.5%, not 5% as was the historical average. If I adjust things to a normal P ratio, the level of the S&P 500 should be 2,700 points, 47% down. If there is a 5% dividend yield, that's 70% down. That's crazy, okay? But 40% down, 2,700 points, that's a level that we've been just a few years ago. So that isn't something as crazy, and this is just the pandemic money printing, nothing else. So from my perspective, the S&P at 2,700 points would be fairly priced. And now, are you fragile, robust, or anti-fragile with the S&P 500? If you have to sell, if it goes down, then you are very fragile. If you bet on it for income, for whatever, pension, university, then you are in trouble holding the S&P 500 at these levels. If you don't care, if you're just happy with the 1.5% dividend yield and happy that it will be 3% in 10 years on the current level of your money, then you're robust. If you can buy more, if we go back to 2,000 points, if you have the dry powder, then you are anti-fragile when it comes to it. On bonds, 4% yield now on 7 years. 4% is below what the Fed offers because everyone thinks that the Fed will start already lowering rates soon. I don't know what Powell said on Friday, but you never know. Not even Powell knows where will rates be in the future. However, given the lowering ahead, rates have already started to go down as people want to lock these longer, higher rates for 10 years. And that's why there is more demand for longer-term bonds than shorter-term bonds, even if shorter-term still give you 5%. The issue here with fragility is inflation, and if you adjust these long-term returns for inflation, return is actually zero. So you don't make any money, which means that in the short term, yes, you have bonds, you are robust, but in the long term you are still fragile. And that is the problem with bonds, because at the end bonds don't give real returns. So that's the fragility there. Plus there is a risk if there is real inflation and the Fed needs to let it run by keeping rates lower to solve debt issues or whatever, then that is really a black swan moment, and that is the destruction of your money. When it comes to the S&P 500 and bonds, long term it is better to own the S&P 500 because it is going to be worth more 20 years down the road. Short-term bonds, long-term if you hold bonds, you are guaranteed that you will have less purchasing power than now. With the S&P 500 it is a little bit different, but it is still expensive, therefore fragile. However, if you don't need to sell, if it crashes, if you can buy more, again, it's always up to you. Walgreens, we just discussed, high dividend but likely to be cut, declining business, Amazon competition, hard to see cash flows going up. Maybe there will be some value now as vultures start circling around it, but it's healthcare, it's difficult to take over, etc., etc. So I would categorize this as fragile, and it's not a stock that you can retire on from now on. It worked great in the past, now not that much. Now we have to see what is the price of put options if you want to protect yourself for 1 year. A put option is an option that gives the holder the right to sell an asset at a specified price. If I go to the option chain, the current level, this is for 2024. So if I want to protect myself for 1 year, I need to pay 4.9% of the current value. So if I have $1 million and I want to protect myself, be 100% that I still have $1 million in a year, I have to pay $50,000 in options. And okay, you can protect yourself from 1 year, but every year paying 5% to get such protection is something that is not sustainable and therefore again destroys your value over time and unfortunately is again fragile. So let's go to strategy, the applicable strategy, and we already discussed from fragile to robust your portfolio. You can do it by not selling because the dividend yield of the S&P 500 will be there. The dividend went from 40 to 30 back in the financial crisis, so maybe it will go from the current 70 to 50 in the worst case scenario. You still get some money that allows you to live or buy more. If you're happy with that, you have a robust strategy. If you sell, if you are forced to sell, you're fragile and you will likely lose your shirt when it comes to investing in financial markets. The next is holding cash with 5% or 0 real returns. Well, cash, short term you are anti-fragile if a crash comes short term, but long term cash is again something that will get destroyed in value, in purchasing power. So long-term fragility there. And there is always the balance that we'll discuss at the end with value investing on how to do that. But keep in mind, cash for now is short-term anti-fragile, long-term very fragile. Then put options, fragile, too costly, and the option I think is the best long-term is value investing. And as value investors, we buy when there is value. If no, treasuries are great as long as we don't have anything else. And if you look at Buffett's cash pile, you can see how Buffett is doing. He owns these great businesses and he doesn't care about anything else. When things are cheap, his cash position is incredibly low. When things get expensive, his cash position is high because his businesses do well, do a lot of cash, and he doesn't like spending too much. Now, look at this, stable, stable, stable. Then when the financial crisis started, then he started spending his cash, acquiring Burlington Northern Santa Fe, low cash, buying, and then buying Apple, and then stopping there. And okay, also share prices went up. If share prices go down, this cash position will go higher. If not, he will start spending again. But he is there balancing this cash pile and simply receiving every year a lot of cash from his businesses, and then also having the cash pile that make him more tilt towards anti fragile. If you can have such a portfolio, then you are set. The question is always, what is the value to you of whatever you find out there? What's the risk and reward? Can you handle it? That's the core portfolio strategy. If you are forced or you will be forced to sell in the worst case scenario, then you are weak and fragile and you will lose your money. If you cannot sell, you're robust. If you can buy more, find a way to structure things that you can buy more, and then that is the winning strategy, not only for 2024, but for all years. If you want to check my portfolios, check my research platform. Thanks for watching. See you in the next video.